And as to bring me to research report, this is kind of a summary section. We have over 3,000 research reports in our database. And part of what I've done here is if I run a portfolio of 20, 30, 40 stocks, say, and I want to make buy and sell decisions out of that 40 or just monitor the portfolio, there's only so many hours in the day. And what I've done is where I can get through a portfolio as quickly as possible. So here, the best way for me to explain this is it has a risk profile of being conservative to begin with. It has a buy recommendation, but it's also conservative. What makes it a conservative stock is this metric right here, owner's earnings percent. This is straight from the cash flow statement, the cash flow from operations specifically, that I want to know how the core business of, say, Allstate is doing. And I can find that by looking at the financials of the cash flow from operations. Now, the reason I want to do that, this is the core business. I want to make sure that the core business is strong. I have to look at these other things from A to Z, but the first step is seeing how the core business is doing. So when I go down through this research report, you can see that they've had earnings, and now all of a sudden they have owner's earnings coming straight from the cash flow statement. Now, the metrics out of the cash flow statement, we consider that to be more relevant than net income off the income statement. A net income has all kinds of non-cash items to it, has revenue recognition issues to it, has expense recognition issues to it, accruals, deferrals. It's not as reliable, and it's not as repeatable, and it's not as relevant as the information that we get from the cash flow statement. So our analysis really starts and ends with the cash flow statement. We're taking the cash flow statement and relate it back to the balance sheet instead of using net income to relate it back to the balance sheet. So here you can see that we have earnings and cash flow from operations, free cash. All of this is solid, very consistent. All this looks good. But here you can see the 5-year history of how the cash flow from operations are doing and the free cash. So this company it has maybe 22%, 23% leverage, has plenty of money to pay the dividend. And you'll be surprised how many companies do not have free cash to pay the dividend. So when I come down here, what we like to do, here is the owner's earnings. Down here, Allstate is right here. And these are all the companies over here that are not making any value added to their shareholders. In fact, they're losing money for their shareholders. There's no value added. So what we'd like to do is find out where our stock is here. These stocks here are the stocks. When I say there's not enough hours in the day, I cannot do research in all of these. I don't have time. I want to do research over here. These companies that have a low to invested capital ratio right here and are making good money. This is where I want to spend my time understanding these companies here. This company up here, oh, by the way, if you join us, you have to remember this button over here to the right. It saves you a lot of time. But here, Allstate looks very good in this sector. We like it a lot. Another stock in the sector is AIG, very well-known stock. In the street, it probably has a neutral opinion across the street, but mainly because the owner's earnings is negative, it is a speculative stock. Now, this is a big, important company, but we have an opinion on their fundamental is negative. The market profile, we also make a technical opinion on the market profile of a stock. It's also negative. Here, the relative strength against the S&P is below 1. Above 1, it'd be outperform the S&P. It's there because we have some independent RIAs that are pretty much expected to outperform the S&P every quarter. So they like to buy stocks that have a positive relative strength. But here you can see the dividend. They have plenty of money to pay the dividend. But the growth component, every stock we buy has to have growth. Our growth stock has to have a value component to it. It is this invested capital multiple. We want to know where that is. That's our risk component. This is our return. It's almost like a cost benefit analysis very quickly. So another company that's in this group. Now, if you remember this, going back to this chart, see this chart way up here? The industry's down here at 1 or 2. This is what the street expects for the industry. An outlier like this that's losing money is abnormal. And I guess it's a very good example of the story versus reality. I don't know why someone is spending 10 times invested capital multiple and you have a negative owner's earnings. The PE has negative earnings down here. Everything's negative about it. But these have got to be the happiest shareholders in the world because their fundamentals are very bad. They must have a great story tied in there somehow. But in the past, I have always bought a great story. I've never bought a bad story. It's just when the fundamentals don't catch up. So if you're going to buy into the AI, something that has high expectations, a way to measure this is through the cash flow statement. So if you're bullish, there's a couple of stocks there that we would recommend that you could buy. Another stock on there was Lyft. And this stock, again, has a buy conservative rating, but its fundamental and market profile are both positive. We like that. This is like 10% above the S&P. We like everything about this company. And when the stock is at 22, up here at 22, and it's selling for 59 times earnings, someone is happy to pay 59 times earnings for this company. But our price to owner's earnings is maybe less than 9. So if there's ever a margin of safety in the way we see the world, it's this right here. And what I've tried to do is get these fundamental statistics over a 3-5 year period in visual form. It's a little easier to see where all of a sudden this stock started to become more. Down here is all speculation that someday they'll be here. And sure enough, they made the corner here, and now they're making a great return. They're in the same business as Uber, but they're just doing a better job at it all the way around. So we like how this profile looks. One thing we like a lot, that their sales to invested capital, for every dollar I give them, they have $4 in sales. I like that. This leverage, to me, they should be leveraged up. If they're having this much success with their sales are relative to something, and they're relative to how much money you put into things. I assure you that corporations do not make asset allocation decisions based on GAAP accounting that's reported to the SEC and in these filings. They make asset allocation decisions based on cash return on invested capital minus the cost of that capital. So when you see a company having its sales from its operations, some people say, well, that brings alpha, that brings out performance. But the way I see it is I now have a company that has pricing power. They have success with their cash flow from their core business, and they have pricing power. And in today's world, capitalism is equal to inflation. You have to be able to deal with inflation, and you have to have. So if you have a portfolio of what we call the good ones that are strong cash flow positions from their core business, they have pricing power to go forward and deal with some inflation. Now you get hyperinflation, and that's not good for stocks either. That's not good for anything other than maybe gold and Bitcoin and some off-system stuff. In fact, you can see here, Lyft is at the top of the list in this internet services. This is really kind of interesting. Here's Lyft, here's Google, and here's Meta, here's Netflix. These companies still making money, but there's plenty of companies that are doing better than these guys. Now, these guys, if we look through Google and Meta, what we would find out, they are investing insane amounts of money in AI. They've gone through most of their free cash, we'll say like Oracle. They went through their free cash and now they have big debt. So there's a way to follow. Now, again, these Google and Meta, these companies have great expectations because of AI, but the way to measure how the reality of all this comes along, can that industry meet the chips? Can it meet the electricity needs all on time after all of this money is borrowed? The way to do that is to follow the cash flow statement. Now, a couple, say, ideas. If you're bearish, but now here, part of this, we'll have videos, we'll explain each part of these items we have, but we also have a sell short list, large cap, mid cap, and small cap, these all caps. Now, these companies have huge cash flow problems, okay? And there's a lot of companies in the healthcare business, but in this managed healthcare, everything, the fundamentals negative, even the invested capital is selling at what, a 60% discount from the original invested capital put in the outfit. And so, but they're still showing earnings. You can see that they're still showing earnings here. These earnings look great. And this kind of reminds me of all the different conference calls I've been on over the years, over the decades. And you always hear the CEO or the chief financial officer talking about how great their earnings are. What you don't ever hear is, oh, by the way, our cash flow really sucks. You don't hear anything about that. So you have to dig it out. And right now, for some reason, this outfit is missing out on its core business. Now, I'm not really interested in cash flow from investments, cash flow from financing. I am really interested in the core business and how the core business is doing. So right now, you can see here, I don't know how you have earnings other than non-cash. These are all non-cash items. You don't have any cash flow from operation, no free cash, got a little bit of CapEx involved. But this company it's not our kind of company. And it's up here at 46% leverage to begin with. So if you're bearish, that's it. Now, in some cases, say if you put $10,000 short here, you could also buy $10,000 of SPY and work the spread. But what you'll find as you start using this, we have a market profile. If this market profile turns positive, we will probably leave, no matter what the fundamentals are doing. It's almost like if I'm long and the market profile is getting hammered, I'm not going to get caught in a value trap. And here, I'm not going to get caught all of a sudden if this stock starts participating better than the S&P and I'm staying long for any reason. So that goes for all. So right now, in our sell short all cap, we have 53 companies that we're short, and that's quite a bit for us. So it's the criteria to get short is pretty tight. So let's say another company that we see, our SP. Here's another company on that sell short list, another healthcare. And we have a lot of sell shorts in this industry group. But you can see it's the market doesn't like it. they're missing out on their cash flow by a lot, but it has a positive invested capital multiple. Someone is paying 1.8 times invested capital for this. Now, again, they have got to love the story that goes with this company. But the fundamentals, at some point, the story has to face reality. And so for us right now, as long as we'll stay short as long as these numbers stay together. Now, another thing that we have is a dividend list. Now, this has a dividend yield above 5. I see this was not at 5, but above 5. And say we have maybe 23 stocks here, and this free cash payout ratio, we take free cash, well, we take the dividend amount divided by free cash. Well, actually, we take it the other way. We take free cash divided by the dividend amount, and as long as that payout ratio is above 1, we're good. And so all of these stocks that have a growth component, each one of these stocks, they may not have, like here is William,
connection loss.
Western Union. Now, they have a little bitty owner's earnings, but there is a positive growth aspect to this company. The market likes it, and it pays a 10% dividend. Here's the dividend chart. So this is a 10% dividend over here, and they've had free cash, and they've kept this dividend the same. It's just the stock price has come down to make it a 10.3. So now the long-term return from 29 to 25 is like 8.25% net of inflation. So if I'm sitting in an IRA 401k, I'm happy with this yield right here, especially if you're not quite sure if you're supposed to be bullish or bearish in these retirement plans. This thing works great. Now, to give you some idea how often we have a section where you can build your own portfolio, put your own portfolio in there. And what I've done is, see, this is DVY is a dividend ETF. I think they have 100 stocks in it. I only could show 92. So I bring this and I put in free cash payout ratio. So what we're going to do is find out of the stocks in this dividend. Now, the only reason to buy a dividend ETF is for the dividend. You're not really buying it for big time growth. But here are all the stocks that have positive free cash to pay the dividend. That's 52. So from here on, they do not have the free cash to pay the dividend by a long shot. Close to 40% of the portfolio in a dividend ETF doesn't have the cash flow to pay the dividend. So the next question is, if they don't have the cash flow, not net income, has nothing to do with net income. Dividends are paid out of the cash flow statement, out of free cash. If they don't have free cash, there's only two things they can do. They can borrow money to pay the dividend. That's not good for your principal. Or they can sell stock to pay the dividend. That's not good for your investment. So this is why when I go back to our dividend list, it's very important that these stocks here on this list have a growth component to them, and they're paying a great dividend. So now our idea of a portfolio is a bottom-up analysis that we think that you should have 60% of your portfolio in stocks through all weather conditions. Maybe 40% is a top-down approach. Maybe you should look at the macro environment and macro signals. There's plenty of people on the internet that I think do a very good job with this macro call. But when it comes to allocating to stocks, not to the S&P 500, the S&P 500 has the good ones and the bad ones. We keep saying buy the good ones because they will perform better, gives you better price protection in inflation than the companies that are not bringing value added. So, and again, it's you have time. If you can use some of these tools, you can have time to know what you own and why you own them. Even if you have an investment advisor helping you, the more you understand of what you own, the better conversation you will have with your advisor. I can promise you that. So anyway, that's about it for today. We'll be doing a couple of these videos every week. And so everyone have a great weekend. And remember, buy the good ones. All right. Thank you.